Welcome back to QAV TK, episode 429. How are you today?
Very well, Cam. A little bit bleary-eyed after watching the British Open for the last 4 days at night, but no, good. Living the life in lockdown.
What hours is that on?
It was coming on about 7 at night and then going through to about 4 in the morning, but I didn't stay up the whole time.
How long do you stay up?
No, I was staying up until around midnight watching it and then sort of checking things again about 4 in the morning to see how it finished.
4 in the morning?
Yep.
You have to get up and do a 4 o'clock in the morning pee break like I do?
I don't know. I was just waking up naturally. Got no idea.
Just excited.
Yeah, it probably was. Yeah, it's look, you live in lockdown, you just lose all sense of time anyway. Like, it's not like I'm getting up and going to play golf or something. It's just
like being at Crown Casino.
It is a bit, except we've got clocks on the walls here.
Yeah, you should take them down and then you just won't know what's going on.
Yeah. So we had a couple of betting pools going on who was going to win the British Open, and I managed to win them both, which was good.
Well done. Lucky Kynaston, that's your name.
Yeah, well, another spreadsheet on golf tipping. Worked well.
All right. Well, that's good. So you're hanging in there. Looks like your prediction, or Norman Swan's prediction last week, that Sydney could be in lockdown till Christmas might be true, the way it's going.
God, I hope not. But yeah, it could be.
Melbourne's in lockdown.
Yep. That's been extended.
People don't need to be reminded about that. It's all depressing. Let's get into fun stuff. Brent Sweeney, QAV Club member, posted on our Facebook page, thanks QAV investor community, Cameron and Tony. I just completed my financial year-end calculations and I achieved a 21.29% return with dividends reinvested. I started in February, so I only captured 5 months of the financial year. This is in comparison to the AXJOA, the All Ords, that's the total return. Is that the total? I think it's the total. Yeah. Which returned 8.44% from the beginning of February. So terrific result for Brent.
Well done,
I found that 14 out of 19 stocks were in the green, 73% strike rate, which I'm very impressed with. Many thanks. I'm interested to know what strike rate others have managed to achieve. So any other QAV club members out there? I'm actually working on like a little table, like a table where people can post their results, and we can have like a competition. We'll make it interesting.
Like a league table.
Yeah, the winner each month gets to go and spend a week at Tony's place.
In lockdown. At Hotel California.
Yeah. That's great. Andrew McLennan then posted, I've owned 24 stocks in my 14-month QAV journey with a 62.5% returning a positive strike rate. So,
which is about what I get too. So that's pretty normal, I think.
Yeah, 6 out of 10, you always say, right?
Yeah, correct.
That's great. So well done, guys. It's really always great to see people posting the kind of success that they're having. Tony, can we go over the wording of the 3-point trendline stuff in the Bible? Because I had it backwards and forwards with somebody the other day, and I got all discombobulated.
Sure.
Because we've had a couple of discussions about this recently in, I don't know, Facebook or emails or something, and I know it's it's in flux. It's a bit fluid, the wording at the moment.
Yeah, it is. I don't think the Bible has the fat bottom and flat top lines, flat bottom and flat top lines in it yet.
No, it doesn't. Good point. I have to do that.
Yeah.
But this is just about... Sorry, this is just about drawing the lines outside of that. So it says to draw a byline. This is on page 17 for people playing along at home. The rule on a 5-year monthly chart, i.e. a chart which shows month-end prices over 5 years, mark the highest peak after the last breach of a sell line. Mm-hmm. Is that true?
Yeah, it's the buy line follows a sell line.
Right. But when I'm drawing a chart, I'm
Mm-hmm.
not usually looking for the last sell line. When I'm doing a buy line, I'm just doing the highest peak, the highest point on the chart. Am I doing it wrong? Should I be checking if there's a buy line
you are.
or something?
Yeah, so you should do what you're doing and then draw the sell line, and then check to see if the buy line is before the sell line. If it is, you need to draw another buy line later on. So it's probably better if we work through an example. What's a good example?
Let's look at one of the ones that we're going to have to talk about later. CBA. You want to do CBA?
Let's do CBA.
Okay.
I'll tell you why. Let's
Okay.
do CBA.
Right.
So how would you start?
Okay. Well, its highest point on a 5-year monthly is like June, end of June 2021. So I'm ignoring that to start with. And I'm going...
Why is that?
Well, because it's been in a buy for a while. It's dropped back just recently, but I think it was a buy well before that. So I want to see when it became a buy before it went on its latest run from sort of COVID on up.
Yeah, so you want the buy that comes after the sell, the last sell.
Well, I would go back and find the highest point before the latest run. So that is April 2017, I think, $87.40.
Yep.
And then I would normally draw a line through the next highest peak to the right that's not cutting anything else off, which I think is probably January 2020.
Yeah. Yep.
Okay, so that is straightforward. And if I dragged that out, it would have told me that it had become a buy.
It's the only problem is that's a flat top.
Oh, yeah, it is, right. Is it really?
Yeah, so...
Oh, is it?
Yeah, well, just using the segment tool and Stock Doctor, I'm seeing minus 2.77% between those 2 points.
2.83%? Is that what you said?
Yeah, I had 2.77, but
yeah, okay. Close enough.
The points don't always anchor on the peaks, yeah.
Okay, so that falls foul of the flat right line rule. So what do we do then? Do we take the last one as the first one?
We do, yeah.
Right. And so then we're drawing it through January 21?
January 21. Yeah, peak to peak. Or you can actually draw it. You're actually drawing it before then, Cam. You're doing it through July 2020. Oh, right. No, sorry, you're right. No, the next one's higher. Sorry. January 21, yep.
Okay, so January 21. Then I have to work out what the previous sell line was.
Yeah, so I think this will be a fairly straightforward one. You should do it, but I think you'll find the sell happened prior to January 21. So prior to that, where it crosses, sorry. Right.
So the previous sell line would have started, May 18 was at 69.3, but then October 18 was at 69.23, and then January 19 was at 69.1. So what's that? Oh, that's only 1.3%.
So, okay, so you could do, I'm not going to start where you're starting. I think again, we start with the low point on the graph, which is March 2020.
Oh, so I don't need to go back before that first peak for the buy line?
No, the point is we draw the buy line as we have, and then we draw the sell line and see if the buy line comes after the sell.
So you start COVID cough, March 2020. What are you going to use as your L2? No, September?
L2, September, yeah. However, that's a flat bottom of 4% difference.
God, 3%. I got, yeah, okay. So
then we use September as L1.
Yeah. And
then
February?
the next lowest peak to the right is going to be February 21.
Which is the sell line that caused you to sell today, or call a sell
Correct.
today.
Yep.
Okay, so the buy line that we drew started in January 2020. So that comes before the current sell line, but
Correct.
there would have been a sell line before that. The Bible says,
Correct.
mark the highest peak after the last breach of a sell line. So, okay, let's go back a week. I know that you've decided that you're going to sell CBA today, but go back a week before that occurred. What would the last sell line have looked like then? Is the last sell line the last time it breached the sell line, or just the last sell line in theory, even if it hasn't breached the sell line?
No, it's the last time it breached. So it would have been, as you were starting to say before, back around March 2019 and then probably up through December 2019. Although I'll have to check that because it looks like there's a flat bottom going on there. So it starts with May 2018 and then goes through October 18, January 19, March 19. But if I draw a line through those, there's only like 1.5% between all those points. I'm going to take the rightmost point there, which is the last one on that flat bottom.
March 19.
March 19.
Yep.
And then put it up through October 19. Or actually then October 19 would probably mean we want to use December 19 because there's a trough after that.
Yeah.
So then I'm going to sell back in February 2020.
Yeah.
So our buy line's fine. It comes after that sell.
But it starts before the sell. We've got H1 in January 2020 and the sell in February 2020.
Yeah, that's okay. They've got the last sell would have been February 2020, and the current buy that we just did before was March 21. So that comes after the last sell.
Yeah, but the wording in the Bible says, mark the highest peak after the last breach of a sell line, then mark the next highest price or peak to the right of the first price. But what we've done here is H1 comes before the breach of the sell line.
Okay, yeah, I see. I think the Bible's wrong then. We're just looking for a buy line that comes after that sell line.
Yes, right. So what I think it should say is you mark the highest peak, then you mark the next highest price or peak to the right of the first price, which comes after the breach of a sell line. That's the second H peak that needs to come after the sell line.
Yeah, true.
That's what I thought. And that's actually as you put it to somebody in an email or a Facebook post or something last week. I can't remember who it was, but you said that. And right. Okay. Well, that was exhausting, but all right, then
that's
you draw
been
a
my
line
life
through the
for the
2
last
points.
week or two, like going through it all with Dylan, trying to code it and other people. Yeah.
Right. Okay. Well, let me just make a note in my revision history that I changed that. Okay. All right. Well, I'll post that CBA chart up onto the website, and people can have a look at it and compare it with their own. But that's instructive. Thanks for walking through that. And shout out to, I think it was Andrew who picked up that there were some wording changes in the Bible that he was confused by, and good reason to be confused because it was probably wrong. I don't know how that crept in there. Sorry about that, Andrew, and anyone else who's been confused by that. Surprised no one else has picked it up and asked me about it actually before now. Paul on MML, he's talking about your deep dive into Medusa mining last week. By the way, have you seen what's happened to its share price since then?
No, what's happened?
Nothing. It's
good.
But, what Hum's up 7% today. GLE is up 9% today.
Oh, fantastic.
Well, fantastic for me. Yeah, it's nearly back to what I paid for it. Yeah, but you were talking about, you did your deep dive on M&L last week, and Paul says, hi guys, really like the analysis of MML. One thing that might factor into the depressed price is their safety record. I think there's been a number of deaths at their mine in the last year, which makes it an unattractive ongoing investment for many, myself included. On the plus side, a quick perusal of ASX releases shows the CEO is purchasing shares under a superannuation trust he shares with his wife, which would not show up on the Stock Doctor register. Although small purchases, it does appear to be a positive pattern. Cheers, Paul. What do you think of all of that, Tony?
No, it's good analysis from Paul. If I wasn't aware of it, I'd have to go and look at what their safety record is and whether it's a cause for concern. Obviously, it is if someone's died, but I just don't know how bad it is. And I'd expect for an ASX-listed company that if they've had a death on the mine, that they'd be doing a lot to improve their safety procedures as well.
Right.
But yeah, I haven't looked into it.
Okay. Thank you, Paul. Tony, can I ask you a question about working out my portfolio performance for the last financial year? As I said earlier, I was putting up this like table for QAV club members to report their performance. So I thought I should work out my performance for last year. Mm-hmm. And, you know, I bought and sold a lot of stuff last year, had a couple of stocks that did really well, a couple that didn't do so well, had to sell a bunch of stuff because I needed to pay bills. And then right towards the end, like early June, late May, early June, bought a bunch of stocks, added a lot of capital to it. And so if I look at my portfolio report in ShareSite or Stock Doctor, it says something like 5% for the year.
Right.
But I had some stocks that went up 50%, 70%, TRS, I had CCP, both had really good runs for the year. So it doesn't seem to reflect what really happened. So I tried to break it out. I did a download or an export out of Stock Doctor into a spreadsheet. And I remember because we talked about this some time ago with one of our QAV club members, and we were saying, you know, if you have a lot of capital going in and out, you need to look at each stock and work out what the performance was on that stock that you bought and sold, and then tally up the performances to get an overall performance. Is that right?
I don't think so. I think if you put lots of capital in the last month, that's going to depress your performance because it's going to give you the all of the appreciations, less depreciations you've had over the year, over that last capital base probably.
Yeah.
But it depends on the method of calculation. There's very different methods of calculation. Sometimes it's the average capital base. Sometimes they just take this ending capital away from the starting capital and then put that over the starting capital to give you a return. But that's not going to be a fair comparison because if you put a lot in at the end, it depresses the return. Sorry, right. It improves the return. If you started off with $10,000 and you put $50,000 in the last month, you haven't made $40,000. You've just added more capital.
Yeah, right.
Yeah. So I think what we talked about before was doing it month on month, and then so in that last month, if you put a lot of capital in and didn't have much of a return, it's just going to be 1/12 of the final calculation.
Right. Okay.
So if you do starting amount of capital, and then at the end of the first month you work out what the increase was, and then do it for the second month, third month, etc., and sum all those up, that's probably a better calculation. But it's a complicated way of doing it.
Right. What I did, as I said before, was I looked at all of the trades. Mm-hmm. And the ones that I sold, I worked out what the performance of them was during the duration that I owned them. The ones that I didn't sell, I hadn't sold by the end of the financial year, I just did a mark to market for the end of the financial year and calculated what the performance of it was. Then I had TRS. I had a couple of parcels of TRS which I owned before the beginning of the last financial year, but sold during the financial year. So I did a mark-to-market on what they were worth at the beginning of the 2021 financial year and calculated from that. So then I ended up with a table of individual performances for each stock and added those up. That said my portfolio was down 57% for the financial year, and I thought, well, that doesn't sound right.
No, it's because you're not. If you'd worked out the volume weighted situation for each of those stocks, you're still going to have the same problem that you put lots of capital in towards the end. Right. So I think the best way to do it, if you got lots of in and outs, is to do it month on month and add up the months. Like
I've been doing for the last couple of years with the QAV portfolio, just monthly results.
Yeah, we're doing a mark to market each month for sure. Yeah.
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 Well, that's
which is not quite what we were doing with the dummy portfolio. We were doing annual ones as well. Because the portfolio doesn't have all those ins and outs in it. We didn't introduce any new capital.
Yes. Yeah, right. But I was doing a monthly end-of-month summary with the mark-to-markets and all that kind of stuff.
Yeah.
Well, that's time-consuming and annoying, Tony. I don't want to do that. Why don't these platforms like ShareSite and Nevexa and Stock Doctor do that for me?
We'll probably need to talk to them or an accountant because I'm not an expert in this field. They probably do. It's just what are the options you can select. We're getting into money weightings versus other weightings, so I'm just not sure what the option is.
I'm sure one of our listeners knows, you know, how it works. Somebody please tell me, because it's did my head in this morning. I hate spreadsheets, as everyone knows. Okay.
Yeah, I can't help you much more than that because, you know, over time, all that kind of ins and outs should even out to a certain extent, I'm assuming.
Right. And it probably helps if you just, well, I guess if you'll always be adding more capital if you're lucky.
Yeah.
Yeah. So you still got that situation where you need to work out if you add $1 million in, what's the performance if you're trying to keep track of it?
Yeah, my I guess the way I've done it for myself is to ignore the capital inflows and outflows because if you had inflows in 1 year, it resets the base for the next year. You've got to get a return off that capital anyway. So if this year looks good because you put money in, next year's got to look good as well because of performance, not because the money was already in there, if that makes sense.
What if you add more money the next year as well?
Well, if you're adding money every year, you're going to look really good over time.
if you're using a dodgy calculation, but if you're actually trying to work out the actual performance, it's complicated.
Yeah, there are. I've done it before using IRR calculations, which is a formula in Excel, which takes into account each month's ins and outs. So it gives you a better calculation of your internal rate of return.
Right.
But that's kind of, again, that's kind of theoretical.
Okay.
Only because it's like say it calculated you had a 10% return for the year. What does that mean for you? You had so many ins and outs, it's pretty hard to make any decisions based on that. And if you took lots out in the first month, that might affect the internal rate of return, and put lots in the last month, it'll still affect the IRR.
So how do you know if you're doing a good job or not?
Stop taking money out of your portfolio.
Oh, it's easy for you to say.
Yeah, my guess would be to do it month by month and add it up.
Okay. I'll have a crack at that. Thank you. All right. You wanted to talk a little bit further about the question we had last week. We had a young fellow, 25, said, if you were 25, what would you do? How would you do it? You wanted to expand on your answer a little bit?
Yeah. So this is a bit like the article we wrote on private school education and what it would be worth to you over a long period of time if you took that money and invested it using QAV. So the benchmark answer to the question is to take a pot of money and let it accumulate without touching it for 30 years. And I've compared that against something that we've done ourselves, which is a blend of using property and gearing and investing in the stock market. I just wanted to run through that. I hasten to add, this is not in any way financial advice for the person who asked the question, but I'm doing it to highlight a couple of things. One is the use of gearing, and two is I think one of the things which I found useful and motivational over the years, and we spoke about briefly before, is doing up a financial plan in a spreadsheet for your own circumstances and to play around with those numbers and see, what a period of time that suits you and your horizons might look like. So I've just done a quick one on my computer, and I assumed the person who was 25 could invest for the next 30 years until retirement at 55. And I've put some other assumptions in which may be unrealistic for a 25-year-old, but they make the math easy so we can talk about it. And the assumption I used was that the person went out and bought a house to live in which was worth $1 million. And I picked that number because it's a 1, so it's easy to do the math, but that might be unrealistic that someone could do that at 25. But interest rates are low. So generally, to buy $1 million house, you'd need a deposit of $200,000, and you'd borrow $800,000 from the bank. And I let that run just without doing any sums at all. I let that run for 30 years, and which is pretty much how most people in Australia do their investing. They go and buy a house when they're young, as soon as they can, and they live in it. And when they get to retirement age, they sell it, pay off the debt, and go from there. Work out their retirements, buy a cheaper house, use the difference to invest for their retirement. But that house, using a 9% inflator for the house, would be worth about $13 million after 30 years. Excuse me. So the gearing doesn't change. So that $800,000 of mortgage, I guess it'll get paid off over 30 years, but it never got higher than what it started, which was $800,000, which means the equity is now 12.2, which is a nice sum. I mean, you've got to take into account that $12.2 million in 30 years' time isn't worth $12.2 million now. So then, next base case to compare that to is to have $200,000 of equity, instead of using it for a deposit in your house, to go off and invest in the stock market using QAV. In other words, it grows at 19.5%. And after 30 years, you get to $31 million. So that's better than putting it into your house and letting it accumulate over time. That makes sense because the house accumulated at 9%, and QAV is accumulating at 19.5%. But there's kind of a blend which worked for me, and these aren't my numbers, but I just wanted to share them as an example. So the thing to note, first of all, is if you go out and buy a house with $200 down on $1 million, over the first 5 years, say, the value of the house grows to $1.5 million, and that's just 9% growth every year. But your equity, because the mortgage hasn't gone up, it's still $800,000, your equity is growing to be $700,000, which is actually about a 30% return because you had leverage. So that's actually better than QAV. So we kind of need to harness that, which turns out to be a blend of investing in your own home, letting the equity grow because of natural growth and gearing, and then redrawing down the mortgage and putting it into shares. So, for example, after that 5 years, the house is worth $1.5 million, but your equity is worth $700,000. The gearing is worth $800,000. So you've actually got a lot of equity. Your house is worth $1.5 million. You can go back to the bank and say, how much would you lend me now that my house is worth $1.5 million? And the bank would say 80%. So you can increase your gearing, reduce your equity. So if you geared up again, you would have $1.2 million worth of gearing, which is 80% of the new house value after 5 years of $1.5 million. which means your equity's dropped to be $300,000, but you've got an extra $400,000 there to put into the share market. That new gearing, if you like, doesn't change over time. So after another 5 years, so 10 years into this scenario, your house has gone up in value again. It's now worth $2.3 million. Your gearing hasn't changed at $1.2 million. So you now have equity of $1.1 million. If you've invested the share into the share market and the $400,000 that went into the share market when you re-geared is now worth $1 million, you've now got $1.75 million or $1.7 million of equity after 10 years. So you've turned that $200,000 into $1.7 million over 10 years, which is quite a high return of equity. Return on equity and CAGR, cumulative appreciated growth. And then if you sort of let that continue on, at the end of 30 years, you would then have $48 million in equity because the house keeps appreciating at 9%, but the shares keep appreciating at 19.5%, and your gearing hasn't changed, and you probably paid it off anyway over that time. Bear in mind, you need a job to pay for the gearing, but bear in mind as well, you're getting some income from the dividends. And at a certain point during that investment process, the dividends get large enough to pay for all the gearing.
Right.
So you can stop working if you want. For this calculation, I haven't worked out what it was. Anyway, if you did it again, if you re-geared again and invested in the market after 15 years, without going through all the numbers, it gets to $64 million as your total equity, which is better than starting off with $200,000 and putting it in the share market where you ended up with 30. And it's all because of the power of leverage, and the fact that the gearing doesn't increase over time, but the house appreciates in value and the stocks appreciate in value. And eventually, as we said, the stocks can pay off the mortgage and keep going. So I think it's worthwhile for anybody really to sit down and do this kind of calculation for themselves, put their own figures in, work out their own time horizon, knowing their own circumstances, work out when they're comfortable re-gearing and putting the increased equity into the share market, and doing this calculation for themselves. It's quite motivational, and for someone who's got 30 years to go, it can become quite a big sum.
Wow. Can you share your spreadsheet with us?
I knew you'd ask that. I'd probably prefer to. Yes, I can. I'll tidy it up. It's just notes for me at the moment, and share it within a week or two.
Okay.
But I'll share it as basically a template for people to do their own plans with, so they can punch in their numbers that they think suit them, and then they can see what it comes out with at the end.
And what about for people who are 50, Tony? Where do we
you
start?
You can still punch numbers in. You've got, how long do you plan to invest for? 20 years? 30 years?
The rest of my life. I'm not sure how long I've
there
got.
You go. So these numbers still apply to you.
So the same thing works whether you're 25 or 50.
Correct, yeah. You'll have to put your different assumptions in about gearing, because if you don't have a job to pay it off, that might be, because you've retired, that might be difficult. But yeah, you can play around with the numbers and come up with your own projections.
Terrific. Yeah, I hadn't thought about that before, the power of the gearing.
Yeah. Yeah, and that's the real benefit of owning property. And of course, a couple of other comments to make was this is basically what I've done over the years. The numbers aren't real for me, but we've bought and sold property along the way. We've kept property and negatively geared it, and then bought another property. So all those things muddy the waters. But they can all be spreadsheeted and planned. And a couple of other things to point out is when in this model I'm just using an interest-only loan, so I'm not, you've got to take into account that these days interest-only loans aren't as easy to come by. So again, it just delays the period of time until the shares are big enough to pay off both the principal and interest for the loan. Whereas when I did it, 20 odd years ago when I started, you could pay off just the interest component, which was cheaper to do. They're still available today. I still have one, but after the inquiry, the bank has cracked down on them and how much they'll lend, interest only.
Right.
But in my principal and interest mortgage, I still have an offset facility, which means if I put money in the bank, it offsets the interest. And I have a redraw facility, which means if I have paid as the variable nature of the interest rates change, but the repayments don't, if I've got ahead in my repayments, I can redraw it. So, there are other ways of doing it. But I think also too, no one laid out this map for me 20 years ago. So I had to sort of problem solve this and game it along the way and spreadsheet it and plan it. And that's the challenge I'm throwing out to the 25-year-olds out there is you may not be able to do exactly what I've done, but work it out for yourselves. Maybe investment properties allow you to gear. And when they increase in value, you can put the money into the share market at a better rate of return. Maybe you start off in the country and buy property in the country, which, is a lot cheaper than in the city. That might be the way you get your foothold in the market.
It won't all be underwater in 30 years too, like property in the city. It won't all be underwater in 30 years like property in the city.
Yeah. Maybe you want to take on a margin loan, as some of our subscribers have told us they do, at least to get you going. Maybe that's how maybe you do QAV until you get to a $200,000 deposit and then you start buying property. And then you can gear it after 5 years or whatever the period of time is. But yeah, certainly you'll need to solve your own problems going forward. But I just wanted to get people to think about this mentality, A, of doing a plan for themselves, and B, of using the gearing that's available with property to boost their returns.
I think most 25-year-olds probably think they're just going to put it in Bitcoin and then get rich like that in 5 years.
Yeah, and that's probably one of the, I wouldn't say a regret, but one of the learnings for me was that I didn't start doing this until I was 35. So,
yeah,
if I started when I was 25, the order of magnitude of our equity would be a lot higher now than it is. But anyway, that's why I've decided to share this, and that's why it's great for a 25-year-old to be able to do it, because the end numbers are so much higher after 30 years or 40 years or 50 years.
So you didn't get this from anywhere when you were 30, no. You just worked it out. 35, you just figured it out at some point?
Correct, yeah. And along the way, it goes against conventional wisdom. I mean, I had a boss at work who said, what the hell are you borrowing against your house to invest in the share market for? And I just figured that if everything went south, I just had a mortgage on the house, which would take longer to pay off. That was the sort of fallback. But as it turned out, it worked well.
I wonder, if we keep doing this at some point, a few years from now, I think people will be able to go into a bank and say, I just want to borrow money to invest in shares. And they'll say, what are you talking about? You go QAV, and banks will go, oh, QAV, okay, that's fine. How much do you want?
Yeah, right, yeah.
Proven. It's more solid than real estate. Oh, thanks, Tony. Well, there you go. 25-year-olds listening to this. Good luck.
And 35-year-olds and 50-year-olds.
Yeah.
Get out there and plan and see what you can get to.
Yeah.
And play around with it. Play around with gearing.
Yeah. All right. Moving right along, you wanted to talk about 3PTL lines and alerts.
Oh, yeah, just a brief comment. I think I spoke a couple of weeks ago about what I do between reporting seasons, and I said I raised alerts in Stock Doctor. And then just recently, as I was going in looking at the banks, I noticed the alerts were out of date. So it's important to probably every month go in and just check your calculator against those alerts and upgrade them if you need to.
Right. Redrawing the 3PTLs because things may have changed.
Well, because the graphs, there's two things that can happen. The graph moves to the right, and that might change a peak, an L1 or a H1, peak or trough, so you might need to redraw it. But even if you don't, the lines are going to extend that extra month, which means the price is going to rise for a buy and, sell and drop for a buy,
Yeah, good point. All right, thanks. You picked up a bug. Not the COVID calculator bug.
Yeah, look, I picked it up for myself. It's not in the template that's on the website or anything like that, but it may have gotten into other people's spreadsheets as well. I picked it up when I was looking at CBA. So I've taken the template for the 3-point trend calculator per company, And I've copied it 20 or 30 times since then, maybe even more, 50 times for different companies. And when I went back and looked at CBA to update its cell line, there was the part of the cell that does the calculation for the ratio of how many days in the month we've gone through was hardwired into that CBA cell. It wasn't in any of the other cells, so somehow it got overwritten. But it should be a calculation of there's a formula which would go something like equals today brackets over number of days in the month or something like that, and works out the ratio of days into the month. So just check that for me, please, and before you go too much further with your own calculators, and make sure it hasn't copied from anyone else's spreadsheets.
Well, I think the one in our Dropbox is working because I was using it recently and I had another issue, but I don't think I had that issue. I didn't pick it up if I did, but I'll check again. Thanks.
Okay.
Stock of the week.
Yeah, so we've already mentioned that I'm planning to sell out of CommBank, and we're recording this on Monday at the 19th of July. So I won't do it for we put out a stock journal today, so I may do it tomorrow if CommBank keeps dropping quickly, but I'll wait till Wednesday otherwise. And at this stage, I've done a download today. If I was selling it today, I'd be buying Suncorp, SUN, which is further down the list, and but it's big enough for me to buy. So we can talk. I'd like to talk about Suncorp, and I make those two declarations just so I'm not front running people who have also worked out that CBA is a sell today and they want to sell their shares, and then will buy something. Their circumstances will be different. I'm not saying go out and buy Suncorp. I'm saying it's what I'm looking at for myself. So these aren't recommendations. They're just declarations. If someone wants to buy Suncorp, they have a chance of doing it before I do. So I can't be seen to be profiting off them. If I had bought it already and then talk about it on the show, it would look bad. So that's why I do it. So following on from Paul Cody's comment that when we talk about a stock of the week, we should probably just pull it apart a bit. I wanted to go into Suncorp and talk about it. Interesting one. Overall, I think people would know that Suncorp is a Queensland-based bank and insurance company. So interested that Suncorp had recently crossed its buy line. It's sailing pretty close to its sell line, but it's been going up, whereas the banks have come down. So all I can gather is that the insurance side of the business is doing okay, because it should be facing all the sort of problems and issues that the other banks have been facing since the COVID has come back into Australia, but also around the world. And we'll talk about that in further detail when we get to one of the questions about banks. Anyway, Suncorp has a QAV score of 0.12. The current price was $11.31 when I looked this up before the recording. It's large in its ADT. I'll have a quick look at what its ADT is. But let me just have a quick look. ADT for Suncorp. Average daily trade of, 25.9 billion. So quite large. Wow. It's slightly less than the Stock Doctor IV, slightly greater than the Stock Doctor IV, so scores no points there. Has a good yield of 3.19%, so scores a point there, which is above the 2.5 I think we use, or 2.6 we use in our checklist. Financial health is strong. Price to operating cash flow 5.5, PE of 17, which is it's average for the stock market, but probably starting to get up there for a bank. The IV2 calculation is $11.79, so the price is below that, so it gets a point for that. And has good equity, so it gets a point for being less than book plus 30%. Growth is reasonable, but not enough to give it a point, so growth over PE is less than 1.5, partly because the PE is up at 17. It's a bank, so it doesn't have a founder owner or large holdings by the board in any individual case or aggregate, so scores nothing there. It's a borderline N-star income stock, so it gets 1 point, gets half a point for each. As you'd expect, being a big bank, doesn't have a qualified audit, so no red flags there. consistent, strong financial health. It's a new upturn. As I said before, it's just turned up again, even though it's sailing close to its sell line. So it scores 10 out of 15 or 67% for quality and a QAV of 0.12. A couple of risks with banks, same as the banks, and we'll talk about those when we get to the banking question in general. But this company also has insurance, and so there are risks with insurance companies which people may or may not be aware of. So first of all, there's a normal risk that there are more cyclones than predicted for this year, or there's a flood, or lots of hailstorms can affect the profitability of insurance companies. They tend to try and manage that risk when they arrange insurance, but sometimes you get outliers which can hurt profitability. And also too, COVID-19. So interestingly enough, with the Australian insurers, all the Australian insurers were hit by a court decision recently. So a lot of insurance policies excluded COVID-19 from payouts, but a court has ruled that in a lot of cases that wasn't the case, and the contract should be enforced for COVID-19 payouts. So the insurance companies took hits. That happened last year, so most of that's washed through, and they've provided for it this year. So I think we're through that, but it will obviously cause some concerns if when there's more claims arising from the latest lockdown. So that could be a risk as well. Yeah, so that's Suncorp, and that's a bit of a pull apart for people. They can compare it to their own analysis on Suncorp.
Pull apart. I like that.
A pull
Pulled,
apart, yeah.
It's like pulled pork. I have to come up with a name for that. Did you drill down into why the courts ruled against the insurance companies?
I did, but I've forgotten. But it's something like there was policy wording. No, I'd have to look at it. The policy wording was something like excludes epidemics. And there was
I did read up on it a few weeks ago. It was the policy. Okay. The policy wording that they've been using in their contracts referred to a piece of government pandemic legislation. It referred to the name of the government legislation. So it says, we won't cover anything that's covered by this piece of government legislation. But the government changed the legislation 10 years ago, changed the title of the legislation. But the insurance companies didn't change their boilerplate. So they were all referring to an exemption, referring to a piece of government legislation that had changed 10 years ago, and they never changed their contracts. So the court went, well, you said it was this one, and that doesn't even exist anymore, and the new pandemic's covered by this one, so you've got to pay up.
Yeah.
I just thought it was ironic because insurance companies always don't pay because of, some sort of archaic piece of wording in the contract that the signee missed.
Yeah, which
couldn't believe that they all got caught. They all had the same thing. They all had the same wording in it, though.
Was it all of them or most of them?
Well, all the ones that the court ruling was against. I think it was more than one company. Yeah.
It was a fair number, I know. And you're right, it worked against them. But that example and Forum Financial example, which there was more coverage on over the weekend, it's the same sort of thing, isn't it? No one's paying attention, right? The detailed changes in a contract, and no one picks it up for 10 years. Same with the fraud that's going on, or alleged fraud that's going on with Forum Financial.
What we need is like we need a profession of people whose job it is to check legal contracts. I don't know what you would call that profession, what that would look like, but just highly paid. I was going with lawyers, but yeah, white collar professions that get paid a lot of money to check contracts. I think that's what we all need. Hum. Yeah, well, I don't know what happened to Hum today apart from the fact that it jumped back up 7%. So maybe people figured out that the whole Forum Finance exposure wasn't as big a deal as they thought it was.
Yeah, that would be my guess, but I haven't checked the announcements from Hum. Let me just have a quick look.
Bumped right up.
Oh, they put out a business update today. Let's have a look. Fourth quarter 21, transaction volume is up 57%.
Whoa.
over the prior period, or PCP.
Record on it's a kind of drug that you get in clubs in New York.
It is.
Outside of that, I don't know. Record quarterly BNPL segment transaction volume up 68.7% on PCP.
So that's their new buy now, pay later product. So that would have been coming off a very low base because it was only launched last year. So that makes sense. And potentially the transaction volume was down last year because of COVID too, but I'm not sure.
Right.
But yeah, it looks like it's a quite a good update on trade.
Based on unaudited accounts, cash net profit after tax of $68.4 million, up 121.1% on PCP.
Yeah, so they basically they've probably got their accounts in and they're announcing them to the market ahead of their actual update after they're audited. Right.
Previous corresponding period, Google is telling me, is what PCP stands for.
Ah, thank you. Good.
Jamie Oliver's listening somewhere in a car, just shaking his head, going, "Oh my God, you guys!"
I'm just scrolling through trying to find if there's an update on forum in the
Control F, Tony. FY21 cash NPAT includes 1.5 million pre-tax of impairment losses due to balance sheet exposure to foreign finance. Potential exposure from sold receivables is considered to be a contingent liability. What does that mean?
Does that mean that they said it was 12 and now it's only 1.5? I guess it might.
Contingent liability is a liability that may occur depending on the outcome of an uncertain future event.
I must admit, I thought the 12 million exposure sounded like a contingent liability because they'd sold off the business that had the liability.
Right.
But, don't know.
Speaking of James Oliver, I did the transcript of the episode where we had James on and posted that up late last week. Really enjoyed listening to it again and going through what he was saying line by line, word by word. Understood it a lot more the second time around. So if anyone is interested in reading that, you can go to the blog post page for the James Oliver interview, whichever one that was. I can't remember. A couple of weeks ago. And you'll see a link to the transcript and you can go through it and get all the wording.
Just chuckling to myself because I remember after we were finished the recording, I said, that was really good. And you were like, I was an auditor. Talking about auditing.
Don't say so that on the show, Tony. That was a quiet moment between you and me. It's bedroom conversation, Tony. You can't share that.
You can edit me out then. Sorry.
It was a lot for my brain to take in. I think it was at the end of a 2-hour episode too, or that's when we edited it in. Anyway, it was big. Anyway, appreciated that, James. It was, I did. I took it in a lot more. You were getting quite excited in that interview too. You were like, I could tell. It was almost like a US Masters tournament for you. You were all excited.
Well, maybe Jamie and I can go to the British Open next year together then.
I'm sure he'd love that. Okay, banks being close to their 3 PTLs. You wanted to talk about that?
Well, there's a question about it, so you want to just plough through the questions and we'll come back to that?
Oh, okay.
Yeah.
Question, Doug. Hi, Doug. Has Tony tested or considered the idea of not selling, that is, holding a stock, if it is still scoring well on the QAV scorecard but has dipped below its 3 PTL sell line? Case is currently in points, CBA, WBC, ADH, etc. All are still scoring well, but sentiment seems to have turned against them for now. It seems to me slightly foolish to sell out when the numbers are still good and reporting season so close. Surely it could go either way, but the flip side is you'd be in again on the next 3 PTL buy signal, so why jump ship and pay taxes and brokerage? VUK is another recent example.
Yeah, look, it's a good question. Couple of points. So generally with the banks, and I'll address them first, the banks have come out again, which they should, and said things like, we're not going to we're going to give people loan holidays again now that the COVID shutdowns hit Sydney and Melbourne. We're not going to evict people if they haven't been able to pay their mortgages or their loans, or repossess cars if they've got a car loan, that kind of thing. So I think what's happening with the banks at the moment is the analysts are saying, hang on, we factored in all this write back of provisions in the last half because we came out of COVID and it didn't hurt as much, and so the banks over-provided for bad debts and losses, and they're going to be rewritten back into the profit and loss. And then the analysts were also saying and counting on the fact that they would then flow through to increased dividends or share buybacks. And there's various reports out there about what those numbers might mean. Now the brakes are back on Sydney and Melbourne. The analysts are saying, hang on, maybe they're not going to write back the provisions at the level we thought they would, which means maybe no dividend increase, which means maybe no share buyback, at least in the short term, or it's all pushed back 6 months. And that's what's depressing, I think, all the bank share prices in the last couple of weeks. So to answer the question from Doug, yeah, that might be short term. Maybe in 6 months' time when we get through COVID again and we're all vaccinated and whatnot, the banks will start to write back more from provisions and do more dividends or increase their dividends and do share buybacks. But, a lot can happen between now and then. So I'm still comfortable selling those shares now rather than waiting for new. Well, in some cases, the banks don't report next month anyway, so you're waiting until September for some of them. So I think CommBank does. I think VUK might, but the other ones don't. So factor that into your own decisions. So that's the banks. On the other ones like Adairs and Adairs is still way above its sell line, so I wouldn't contemplate selling Adairs yet, even though it's in a downturn at the moment. I think what I said last week is I wouldn't be buying Adairs at the moment because it's going through a downturn with its share price. So that's Adairs. The other point to note is that with the banks in particular, we're using fat bottoms to draw new sell lines. So if we go back and look at Commonwealth Bank as an example that we called up before we talked about fat bottoms, the sell price for CommBank will be much lower than what its current share price is. It's only since we started this concept of looking at a trough as not just being a 1 month event, but it might be 3 or 4 months, and therefore using the full sort of trough to draw our lines that we have started getting, I'll call them hug lines. So started to get sell lines which go up steeply and follow the upward slope for the recent trend. So just looking at CommBank, if we weren't using the fat bottom, then the sell price is going to be around $66, and the current share price is at $97 odd dollars. So it's only that we've started this concept of a fat bottom that the sell line follows the latest upswing. So it's new. It's not. I mean, I did some research on it historically, and it works. And it was part of my investigations into what we do with commodity shares like FMG to get us out if there was a big downturn. So I think it's going to serve us well, but it's new. So this situation with the banks might be a case which doesn't work for this kind of new fat bottom sell line, but time will tell. But given the fact that we're in COVID again, I don't see the banks upturning anytime quickly from where they are now. And if you look at VUK, another case in point, if we have a look at that, it crossed its sell line, its fat bottom sell line, a couple of weeks ago, and we sold, and I sold out of mine, and it's dropped from there. So if you look at the graph of VUK and draw a sell line, and it's continued to drop, is my point, from that sell line. Whereas if we use the old sell line, we'd still be holding, and we won't be selling until about $1.40, and the share price is currently $3.40. So just wanted to raise that point as well. The fat bottom sell lines is new. There might be issues with it, but that didn't come out of any sort of back testing on this. But having said that, I think it's working for VUK and might work for our banks as well. So I'm happy to sell. Another recommendation, Doug might want to go back and not use fat bottom shares and hold them. I fully respect that and take his point about transaction costs. But yeah, I'm selling.
Just looking at the VUK chart here, I noticed that it's still a buy on a MACD from a MACD perspective. I know when we were talking about MACD, you were saying that there's a lag between our sell lines and MACD. This looks like a case in point.
Yep, exactly.
Okay. Thank you, Doug. Thank you, Tony. Mark. Hi, Cam. I was looking at Kingrose Mining, KRM, today. My QAV score is 0.24 and noticed in their latest quarterly ASX release, they've announced the cessation of gold production and they are transitioning back to exploration only. This would presumably mean the cessation of cash flow also. Maybe they should come off the top scorers list. Cheers, Mark.
Yeah, really good pick up there, Mark. Couple of points. It's likely that they'll come off the top scorers list when the results come out because the operating cash flow isn't there, as Mark said. But as we know, if something drops down the list and falls off the top scorers list, we still might hold it. And just looking at KRM, it seems like going back to exploration has been a good thing because the share price is increasing over the last couple of months. So my take on KRM is that people have worked out that the mine life was coming over the last couple of years, and the share price has dropped from sort of 15 cents to a low of about 3 cents back in December 2019, and that now people are getting comfortable with that and getting comfortable with the exploration program and the amount of cash they've got to do that and the likelihood of finding another seam, etc., and starting another mine. So would fully support Mark if he decided he didn't want to be in a gold exploration company and therefore sold the stock. Understand that completely. But the way I would do this from a QAV perspective, and I don't own Kingrose Mine, but the way I would do it is to follow sentiment from now on. So the operating cash flow might go away and will, but if the stock keeps going up, then I'd still hold it until sentiment turned down on this one. Another point to make about the cash flow going away is if people are using Stock Doctor and go into the statement of cash flows for KRM or for any company, across the top of that, the numbers is a heading, and it's got two boxes. One says as reported, or two buttons, sorry, as reported or annualized. And we always use annualized, and that smooths out the operating cash flow for us. But it means that if there's cash flow in this half and next half there isn't any, you'll still see cash flow in the June 20 column. So you might want to look in this particular case at as reported and click on that button. And you'll get the fact that the cash flows possibly ran out because they're not exporting gold anymore. And you might want to use that in this one instance anyway, in your calculations for the checklist. Right. Does that make sense, Cam?
It does, yeah. But it looks, looking at their cash statement, it looks like they're sitting on, well, as of the end of December, they were sitting on $31.5 million in cash.
Correct, yeah.
Which is a lot of cash for them. Going back June 16, at the end of the period, they had $1.5 million, then $2 million, $6 million, $5 million, $10 million, $5 million, $4 million, $19 million, $23 million, $31.5 million. So they're cashed up. And they can probably do a lot with that cash if they're clever little kiddies. Yeah.
A couple of other comments, I guess, like I don't think, I don't know this company that well or where it's exploring or whatever. Generally, exploring for mines won't cost a whole heap. It's a person with it's maybe a team of a couple of people out with a drill wherever they are.
Metal detectors. Just walking around with metal detectors on the beach. I saw someone doing that yesterday. Yeah.
Oh, yeah. Were they drilling for gold or digging for
Mining
gold?
For gold. Looking for
Mining
gold.
For gold. Yeah.
Yeah.
But exploration.
They're just going to hire 1 million people with metal. That's what they're doing with their 31 million people with metal detectors just to cover the land. Oh, it'd be fantastic.
Yeah. Well, anyway, my point was the exploration part won't be that expensive. But if they do strike it and need to develop a mine, they'll need to cash it in. And they may even do an equity raise to fund setting up a mine again. So that's just something to bear in mind.
Okay, thanks for the question, Mark. Last question of the day. Petra, she posted this on Facebook today. I noticed that C6C, round of applause, I got it right first time. First time ever I got that right first time. Has dropped approximately 9.5% today. Not sure. I practiced that before we went to air. Not sure why. Can someone shed some light on the sell line? I've tried to draw it, but I'm not sure if it's right. Looks like it might have breached a while back. And I pulled up the copper commodities price, but I think I did the wrong one again. But it looked like it was coming back as well. Did you look at? Yeah, I think you looked at the copper physical price. I probably looked at the wrong one. The futures.
First of all, just look at C6C. We'll address the sell line with C6C first of all.
Okay.
Petra drew a line that hugs the upward trend a lot more than what I'm getting. I'm getting a sell price of about 69 cents.
Where are you starting?
Using
COVID cough?
March 2020.
Yep. And
then I'll go across to May 2020.
Yeah.
The price in March was 42 cents. The price in May was 50. Oh, sorry. The price in March was 0.42.
Yep.
What's that? 42 cents. The price in May was 50 cents. Yeah.
So it's a lot more than 8%.
Yeah. Is it? Yeah. That's about 8%. I'm just looking at it now. Hang on.
14% I get.
Yep, you're right. Stock Doctor though is giving me something really strange. Stock Doctor's giving me.
It's telling me 14%.
Is it?
Yeah, but it's kind of rough.
But 11%. So that's the line I'm using.
More than 8. Yeah.
Yeah, more than 8.
So that comes in at around about 82 cents if you drag that across.
Yeah, correct.
And it's currently at $3.62. So it's a long way off its sell price if we're using that, which looks scary. I know people look at that and go, oh my God, it's already come off from top of $4.57 down to $3.62. I'm not going to wait for it to drop all the way down to 80 cents.
Well, that's the next point I want to make is that these a graph like this can be a little bit deceptive in that that drop from say 450 to 360 is on a percentage terms. What's that? It's dropped about 25%.
Yeah.
So if you go back, it's had drops which are more than that. So back in say January, when it was 77 cents, it dropped back to 42 cents in March. That's a drop of about 40%. But it looks a lot smaller because the numbers are smaller. So what am I trying to say? If the share price was 20 cents and it dropped 2 cents, that's a 10% drop and looks quite small on the graph. If the share price has risen to be $2 and it drops 10%, that's going to look like a big drop, even though they're both 10%. One's 20 cents and one's 2 cents. So the amplitude gets magnified on the right-hand side of these graphs sometimes. So just bear that in mind when you're looking at a drop. At the right-hand side, it's potentially, percentage-wise, that's still a drop, but something which has happened before, but you just don't see it in the graph that way.
Right. So that doesn't help. That doesn't help if your portfolio is losing money. I mean, people still freak out.
Yeah, but I think people freak out when they see that they see the share graph going down. It looks quite dramatic, but it's not it's percentage-wise, it may not be as big as people are thinking. Like the graph is a bit misleading. Okay. That's the first point. Second point is, I think what's happening with these copper producers is that the underlying graph for the commodity is going down. I'm just going to look up what that is. So I'm using Stock Doctor. If you go into Stock Doctor and type in copper, so I've opened the graph already, and I'm typing in copper, and I'll see a whole heap of copper mines, but I've got copper futures down towards the bottom, which is HG hash, and then copper physical, which is XCU underscore. And so, as pointed out by one of our subscribers, probably copper physical is the better one to use. The copper futures tends to be a bit more optimistic. But copper physical is showing...
Where are you finding this again? I'm in the commodity section.
No, so if you use Stock Doctor Commodities,
yeah,
you're going to get the futures graph, which is HG hash.
Where do I get the physical?
Copper physical?
Yeah, where do I get that? I just type in company search?
Company search isn't working because it's not a company, but where I'm finding it is when I'm in advanced charting for, say, C6C, over on the left-hand side of the graph at the top, it says enter code or name.
Yeah.
And if you type copper in there...
Right.
Yeah.
I typed XCU in there and I didn't find it. Oh, but I see it here.
XCU underscore is actually what it is.
Yeah, right. Okay, I've got it. Thanks. good. Yeah.
Yeah, and so if I draw a sell line with that graph, I'm getting a sell price of about 9181, and the current price is 9309, so it's getting close to its sell.
It's got does it have a flat bottom?
No, I don't think so.
So low point, I've got August 2016 at 4602. Next low point, COVID cough, 4797. Yeah.
You're talking about XCU underscore here?
Yeah.
I've got low point COVID cough.
You got a...
So March 2020.
You're looking at a 5-year chart?
Yeah.
My 5-year chart's got one at August 2016. What's your August 2016 close price?
I don't even have August 20. I've got 2016. I've got my starting price is June 17. Let me just refresh and make sure that's right.
Well, that's not 5 years, right? That's 4 years.
Yeah, correct. No, you're right. It is. Sorry, I had to refresh that for some reason.
But it's all right because it's a flat bottom.
Yeah, that's right.
So it's about 4% difference, 4 or 5% difference. So we're actually using the COVID cough to start off as its L1, right? Sorry for all of that. We got to the same.
No, that's okay. No, you're right. Sorry, I for some reason I'd lost that left hand couple of months on my graph.
And then you're drawing it through May 2020. Is that right?
Correct.
Okay. Yeah. Okay. So that gets us around 8917.
Yeah. 899,000. And the current price is 93.
Yeah. So it's a lot steeper than the C6C sell line.
Mm-hmm.
What would you do if the copper price breaches the copper sell line? What are we going to do? Because we do hold C6C. We would.
Yeah, I would. Yep. Because, and I'd have to go back and analyse C6C in detail, but what can happen with commodities companies is a whole heap of things that are affected by the price, obviously. But like if a company, I'm not saying if this is the case with C6C, if a company is making a small margin on copper or iron ore or whatever, when the share price drops, when the copper commodity price drops down, that could wipe out their profit, which has a big impact on the share price. Mm-hmm. Even just FC6C is making a lot of money on copper, which is probably more likely. That sort of profitability is being multiplied by its PE ratio, and that affects the stock price. And if that profitability is reduced because the copper price is going down, you sort of get that multiplying effect on the share price because of the PE ratio, which acts like a force multiplier on that. So there's those two things. There's also, I'm not sure again about C6C, it could also be, exploring and people are extrapolating from the known reserves what it could be worth, and therefore the price will go up and down a lot more with the commodity going up and down. But generally when the underlying commodity goes down, the share prices go down for these companies, which is happening now with C6C. In this case, I'd use the copper sell line to sell out of C6C.
Right.
Yeah.
Okay. Thanks, Petra. Thanks, Tony.
I think Doug then went on on the Facebook group chat today to ask about other companies and I guess paraphrasing Doug, some of the companies on our list are both gold and copper producers. So what happens to those? I'd have to go case by case and look at them, but with the gold price going, reasonably sideways and the copper price going down, and if it breached its sell line, I'd probably think seriously about selling some of those copper gold companies as well. But,
Right.
it'd be courses for courses. If one's only got a small amount of copper and a large amount of gold, you probably hold it, but otherwise sell it.
Okay. Thank you, Tony. Thank you, everybody, for your questions. That's a full lid. You were reading anything good this week, TK, in your lockdown?
Not much. I've just been watching the golf and working.
All right. I'm halfway through the first Matt Helm novel. Okay. Top of books on China I've been reading. You ever any Matt Helm books?
I remember the movies, though. They had starred Dean Martin.
Dean Martin, yeah. Well, in the Tarantino novel of Once Upon a Time in Hollywood, he says that the Dean Martin movies were terrible. Of course, Sharon Tate was in one of them. That's how it ties into the book, The Wrecking Crew. But he said the books were fantastic. So I'd never read any of the Matt Helm books, so I started reading the first one, Death of a Citizen, 1958 it takes place, and it's good. Yeah, okay. Really good. Really gritty. Very gritty.
I think I saw The Wrecking Crew about a month ago.
It was published in 1960. Oh, yeah? Was it good?
It was terrible, but of its time, it was funny. It's a James Bond spoof. Yeah.
Yeah.
And Dean Martin's fantastic.
But the books aren't spoofs. They're hardcore, gritty spy, pulp fiction-y novel type stuff.
What's the one I should read first, sorry?
Yeah. Death of a Citizen. Yeah, it's pretty good. He starts off, he's like a retired assassin. He's been retired for, 15 years or something, married, kids. He's at some sort of society. He's a novelist. He's at some sort of society party, and he sees a woman that he used to work with, another assassin, come in, hasn't seen her for 15 years. They slept together once when they were killing Nazis. And he goes, oh my God, I guess I better go over and say hello. And as he walks towards her, she gives him the signal, don't expose my cover, I will make contact. So he goes on from there. Yeah.
Well, certainly.
So they're pulling him out of retirement. Just when he thought he was out, they dragged him back in.
The Wrecking Crew, the movie, where he keeps trying to retire and they keep bringing him back in, and he meets up with other assassins he slept with before. But it's like 60s camp comedy.
There you go.
Like a Batman episode from the 60s
it's
TV
like
show.
I was just going to say, like an Adam West Batman.
The guy who used to play King Tut plays the baddie in The Wrecking Crew. That actor. Yeah.
King Tut. I don't remember King Tut.
From the Batman TV
show. Batman? Yeah, okay. Oh.
No, not Vincent.
No, not
he
Vincent.
He was the Egghead.
No, he was Egghead. Yeah.
Right.
Victor Buono. Yeah, right. All right. Well, have a great week, Tony, and everybody listening to this. And we'll be back next time.